Jordan, good to see you. Today we're going to talk through 5 planning mistakes that you really need to avoid. According to Bankrate.com, nearly 3/4 of U.S. adults report at least one financial regret. So today we're going to break down the top 5 planning mistakes. And I know you've been doing this for a while. You've seen a lot. Number 1 is not having a grip on your retirement. GRIP is an acronym. What does it stand for?
A guaranteed retirement income plan. So people need to have a plan that's going to get them some of their money guaranteed so they have more confidence to get the most out of life. So you're not stressed out when you see the markets or different things happen in the world.
I like the sound of guaranteed. All right, number 2, taking inappropriate risk. Taking on too much or even too little can derail your retirement. But how do we know how much risk we should be taking?
Well, we create a plan and then we talk through the plan and say, hey, if you're taking too little risk, we need to get some better returns to outpace inflation. If you're taking too much risk, we might show you how we stress test it. What if the market has a correction here, here, and here? That could potentially hurt you long term. So when we create a plan, we can kind of simulate how much risk you should be taking, but we also got to overlay what you feel comfortable with. Maybe you can afford to take excessive risk, but you don't need to because you know that'll cause you worry and stress, and you don't want to see those roller coaster returns. So we create a plan, we stress test the plan, and then we overlay what your comfort level is to make sure that you don't lose sleep at night, that you have peace of mind no matter what the markets do.
And then next we have a gross planning mistake, which is focusing too much on your gross savings, i.e. socking away too much money in those tax-deferred accounts like most of us do.
Yeah, for decades, people were told defer, defer, defer.
Yeah.
You're going to lower taxes in retirement. The reality is if you keep on deferring now, you might be costing your family tens, if not hundreds of thousands of dollars of extra tax liability. Because we have a short window now where taxes are historically on sale if you look at historical averages. And you have 3 different tax types like we see. We got tax-free money, we got tax-deferred, and we got taxable. But if you have all your money in, or majority of your money in those tax-deferred accounts, that means that you're creating a bigger and bigger tax kind of debt that you're going to be paying on that when you take that money out for retirement in the future. So you want to make sure not only you're diversified from your investments, but diversified from a tax planning perspective as well.
Mm-hmm. Next is not having a plan for long-term care, which is really poor planning because 7 out of 10 people will need long-term care at some point, and it can be incredibly costly.
Yeah, we all have car insurance. We all have homeowners insurance. But if you look at the statistics, like you said, 70% will need some form of long-term care, but people don't want to talk about it or people don't have it. So we will always talk about, we'll always put this inside the plan. How do we encompass for that long-term care cost, whether it's 1 year, 3 years, 5 years, and talk about the pros and cons of different strategies. And it may not be traditional long-term care, but we can talk about alternatives to really make sure that you insulate your plan, but also benefit your family.
Mm-hmm. And then the last mistake is not optimizing Social Security. Only 4% of people claim at the most financially optimal time. The remaining 96% are missing out on what comes out to $111,000 per household.
And I do understand the statistics, but I'll say you can't really put that just in statistics because we don't know exactly when we're going to live to. We don't know
Right.
when we're going to die. The statistics don't factor in family history. So yes, if you take it sooner, you get less money out of it. If you wait to 70, you get the biggest paycheck. But if you pass away at 75, you didn't get the biggest pile of money. So we do optimize Social Security based on the financials. Again, overlaying your health history, overlaying the plan, also looking at your spouse's benefits. So how we can strategically and smartly maximize to get the biggest pile of money.
Mm-hmm. And Jordan, again, talking this through with you, it's clear that all of these planning mistakes are taken care of and addressed when it comes to creating a financial plan with you.
Yeah, we have our trademark safe and secure retirement roadmap, and we believe a lot of firms out there, they focus just on the investments, and we take
Right.
that seriously. We want to provide world-class investment management, but what good is what you make if you got to give it back to taxes?
Mm-hmm.
What good if you don't have an income plan to give you peace of mind and confidence in your spending? What if you don't have a healthcare plan for long-term care or for Medicare? Or what if you do great, but you pay a huge legacy estate tax because you didn't do good planning? So
Mm-hmm.
we kind of do the one-stop shop approach, and taxes at the focal point of that to make sure that you maximize every dollar and you have confidence to get the most out of life.
Right. They absolutely, each puzzle piece fits together. So Jordan, if somebody wants to sit down and create that financial plan with you, how can they reach you?
Yeah, they can call our main number, 847-499-3454. And we look forward to helping you live more today while we create that plan for tomorrow.
And a reminder for everybody watching that we have a great video library, Jordan, on your YouTube page. Essentially, each one of these mistakes, each one of those puzzle pieces, we have separate videos on. So please like and subscribe to the YouTube channel. And again, if you want to make that appointment with Jordan and his team, just wait for the QR code at the end. Jordan, thanks so much for your time today.
Thank you, Aaron.